Welcome to this conversation. The earnings season is here with us. EABL has just released earnings on steroids, and we're delighted to have the CFO, Risper Genga. Always a delight to have you.
Thank you, Julian, and always a delight to speak to you.
Karibu sana. When I look at the F22 numbers, very many sweet spots, but let me start from here. It is an indication to me that the COVID hangover and overlays have finally been shrugged off. The numbers are even above F19.
Absolutely, and I think there is an element to which it is pipe fill. The markets reopened for Kenya really around October and Uganda in January, so being able to get back volumes, and you can see that, is really a factor here. And if you look at the CAGR growth pre-COVID and post-COVID, we've grown faster since F19 than before F19. So we've done the right things. It's a function of doing the right things through the crisis, remaining focused on long-term returns, taking care of your people, and listening to your customers.
I see. Let's talk about your costs, because in this environment where everyone is struggling with tight margins, how did EABL manage to ensure that the growth in the top line fast outpaces the cost of sales?
Yeah, if you look at the numbers, our top line grew 27% and cost of sales 16%. And you remember the conversation we had around we have a factory to run, and some of the cost is fixed, about half of it is fixed. So that half, as volumes come back, and our volumes grew 22%, you're then able to apply the already sunk cost that is fixed, and the only cost that is then growing is the variable cost. So the 16% is variable cost growth. And when together you spread them across more units, then you have a lower per unit cost and therefore better margins.
Selling and distribution up 33%. Quite a significant uptick, but you argue, it justifies where you intend to take the business.
Yes, for us, selling and distribution is primarily around how we reach the customer, how we build our brands. So that is a driver for sales growth. So as soon as the markets opened, we needed to get back in there, needed to get the product in front of the customer, needed to keep listening to the customer to know what are they wanting and how do we make sure we meet that. So investing behind our brands is so critical to the long-term health of the brands and therefore the long-term growth of the top line. So that's one of the things we've stuck with. Our target is to get into the double digits in terms of NSV percentage. We're just sitting at 8.9%, and long term we want to get to 10%. That 8.9 is higher than last year's 8.7% of NSV. So I think we're tracking in the right direction, and that almost helps us sustain the growth that we're seeing on the top line.
Another sweet spot, Risper, is that last year, a time like now, we sat down and we're talking about your cash position. We said 4.4 billion, extremely cash rich. Now you're sitting on 8 billion shillings. And my question is, what's the plan here? Are you winding down debt further?
So the 8 billion, first we have to pay a dividend. And then, as I said before, our business is highly cash generative. We have to pay taxes, excise, we have to pay suppliers, but we also generate a lot of cash. So the 8 billion is cash that is going to be put to good use. We also use part of it for our ongoing investments. So part of our investments are debt funded, part of it is cash funded. In terms of debt, yes, the idea is to deleverage over time. We are within the board-approved ratios, and we're in a period where we're still funding some of the CapEx projects we had started. But we've also started paying down. As we see maturities, we're paying down our debt significantly, but also maintaining a healthy level of debt because our investments are long-term. So maintaining a healthy level of debt to fund the business is still a good thing for our balance sheet.
You've prompted me on the dividend discussion. So two things here. First is that are we back on a predictable and what we could say a market expected dividend? And secondly, companies of EABL's caliber, when they were rebounding from the dividend drought induced by COVID-19, gave dividend yields in the double digits. Whereas I like the 11 shillings per share. It is still in the single digits from a dividend yield perspective. Yeah.
Julian, I think when we didn't pay dividend last year, and it was a very, very tough call, one of the things we shared with the shareholders and with yourself is that we wanted to resume dividend at the time when we are clear that we can sustain dividend payment. Us declaring an interim and a final dividend in the amounts that we've had, at the highest we've had in 6 years at least, shows that we are back on trajectory, and we're fairly confident that we can sustain continuous dividend payment. Secondly, when we talk to the yield levels, I think when we do make this decision around dividend, we look at, again, the long-term growth of our business. We look at the kind of investments we're doing, which will continue to power sustainable growth. And again, we are committed to not doing things that are one-off, but things that will guarantee long-term sustainable returns to our shareholders. So I think as we grow the business, shareholders stand a lot to gain by continuing to be with us for the long term.
In the numbers I saw, purchase of property and plant and equipment at 13 billion, up from 7.7 billion a year ago. Give us more detail on that.
Yeah, it's precisely, again, what we talked about. Through COVID, we continue to investing behind the brands, investing in capacity. You will have seen the biomass plant is now up and running, and it's a sight to behold to see that we're burning coconut husk, macadamia nut husk to power the factory, using the steam, and that's just amazing stuff that we're doing on the ESG side. We are also investing in capacity. We did put in a cube in Tanzania. We are now expanding our Moshi plant. We do see potential in that market for growth, and therefore putting in additional beer and RTD capacity. RTD is ready to drink production capacity in that market is critical to the future growth of our business there. And we've put a good sum of money behind that. Also in Uganda, you've seen the growth in Uganda in the midst of COVID. They grew 33%. This year with reopening again, they've landed at 24% growth. And again, powered by our expansion. So we expanded beer capacity. Now this year we have put in some RTD capacity, and you can see Tusker cider now selling in that market because of capacity, and it's grown immensely. So we continue to invest in the business in order to power future growth. I think the big investments we're doing at the moment will be done by FY2023. So then you'll likely see a tapering of CapEx spend. In Kenya also, we're increasing spirits capacity because, again, we've reached the peak.
Risper, Uganda was intriguing for me because, just as you've mentioned, I thought when I was doing my analysis last year, the COVID growth, double digits, was stronger than what we have witnessed right now. And therefore my question is, how is the on-trade, off-trade shaping up on that side?
I think from a Uganda perspective, more or less the same. There is an element to which people are very similar to Kenya culturally. They want to go out, have a drink. The clubs have been closed for 2 years. People are able to get back in there. And so a lot of the volume we're seeing is coming from that. In the pre-COVID period, we believe our growth was more around, we had volume and people could then access product, and they had very innovative ways around accessing that through border really worked around making home deliveries work for them, and that has been really, really good. So a combination of our capacity expansion, but also growth in home delivery, and with the reopening, people are now back to the club and the bar scene, and our own trade rebounding back quite strongly.
The struggle with almost muted growth in beer seems to be off now.
Yeah.
Yes. Could you please speak to that, and what dynamics are playing out for EABL to be able to deliver this now?
Yeah, I think the growth in beer first is back because the primary consumption of beer is still on-trade. So the reopening of on-trade has helped us that a lot. The factor that is a challenge is excise. With increase in excise, beer becomes less and less affordable. And whilst it's increasing on spirits is more, you serve, the units of serve are, you feel the impact a lot less. So beer growth gets hampered by excise. We've demonstrated this several times. And when you increase the price because of excise and it is beyond the customer's reach, then they fall below the formal consumption line, and you get into some of the dangerous products we've seen in the past that are not only costly to human lives but also to government revenue. So we hope that the engagements we are having with government will help them appreciate some of these challenges and and take them on board. That will be very important in ensuring that beer continues to grow on trajectory.
And that's a good point to pivot into the operating environment. The Finance Act 2022, excise up 10%. What sort of elasticity are you seeing when it comes to the demand for your product, and how is there a limit to which you can pass this on to the end consumer?
Yeah, the Finance Act, hugely disappointing. We had really great conversations which were well understood around the elasticity, the impact on the farmers who are producing sorghum and barley for us, the impact on smaller business who depend on our business will be felt. We do have to pass on the cost. We are not only facing excise increase, we are also facing inflationary rises as well as rising inputs given the global macros. So it's a bad time to apply a 10% excise increase. And so we do see, and we've demonstrated in the past, that when these rates rise, the elasticity does come in and customers are unable to afford, and therefore you support growth of illicit. So it's almost a self-defeating move, and we hope that it is something that will be reviewed in due course.
After years of talking about it and years of waiting, we have finally seen the draft national tax policy. What's your general feel around it, especially around the provisions regarding how long we should have tax laws in place and the items which will be subject to excise?
So one, I think it's a step in the right direction. What we've been asking for is better predictability around tax policy. Our investors are hugely concerned about the unpredictable increases in excise, sometimes twice a year. In the last 2-3 years, excise increase are nearly now 30 to 40%, which is crazy, and you don't see it coming. So having some predictability in tax policy is very important. However, I think there's need for clarity. It is not clear that the 5 years will not come in through some other route. Sometimes we've seen tax changes come in through different routes other than the Finance Act. Also just the clarity of what does it really mean. So I think the engagement with the public and us really being involved in unpacking this and getting it to a place where it is so clear and gives us that predictability in tax policy will be helpful. I also like the introduction of an ombudsman. I think that's something that's much needed. And also the idea of having tax courts, because dispute resolution is just taking too long. So accelerating those is good for the taxpayer. It's also good for government. So I think there's some steps in the right direction. A lot more engagement needs to be done to land it. Even what you raise around what products are subject to excise is very confusing. Products that are currently subject to excise are not in there. We don't know what that means. We don't know how they're going to fill the gap. So there's a lot of clarity needed.
Okay. And closing this tax conversation, to what extent does the divergence between taxation rates in Kenya and other markets like Uganda and Tanzania then inform your investment decision in terms of where you're deploying capital?
It does inform. I mean, right now, the excise taxes in Kenya on beer are 5 times Tanzania and 3 times Uganda. You have to think about that when you're deploying shareholders' funds into investments. So it is worrying. It definitely is worrying. We're still committed to this market. We've invested many, many years and a lot of money into the growth of this market. So we are confident that somebody will hear us and actually do something about the excise. But definitely you will look at more favorable, more predictable regimes as an investor. Is what you have to do for your shareholders.
The overdraft facility, EABL has tapped a dollar-denominated overdraft facility in light of the challenges we're having in this market. And I listened to you and I was curious. EABL has Diageo behind it. You could easily have a standby shareholder facility to cushion you in the event that you need dollars in huge amounts. Why go for the overdraft?
So I think first, Julian, we don't need the overdraft. We have enough cash, as you can see on the balance sheet, and we don't need Diageo to come in. The issue is, at the moment, we fund, as I said, about 12% of our spend is in dollar terms. We need to fund that spend as well as with some of the capex. Now, we fund the spend, and then we get into the market for the dollars. Now, when the dollars are not there, then the overdraft builds up. And you can't pay it with the shillings that you have to find dollars in the market. So that's where we are, and I think the current situation needs to be looked at, and we need to resolve it. It's been there for a while, and that's the unintended consequences. You have the money, but you can't easily convert it.
All right. Risper Genga, thank you so much for your time.
Thank you very much.
Always a
Julius.
delight. Thank you.